Good afternoon. This is Tom Leverone of the Washington Financial Group again. Welcoming back my four compadres. A real quick introduction, please. To my right, I have
Dennis. I'm 19 years old.
Dennis is 19.
I'm Marjorie. I'm 23 years old.
Marjorie's 23.
Hello, I'm Abraham. I'm 19 years old.
We have Abraham, who's 19, and finally,
Hello, I'm Belinda. I'm 19.
Belinda is with us at 19. Where we left off last time, somebody asked a question about investing. Who was that?
That was me.
Yeah, what was your question?
I wanted to know a little bit about stocks and bonds and if I should invest in them or how I invest in them and all that stuff.
Excellent. What do you know, or what's the question?
What are stocks and bonds?
All right, what are stocks and bonds? Okay, well, a friend of mine, a guy I work with by the name of Joe Denori, told me this story once. When you're talking about stocks, you want to think of yourself, when you buy a stock, you become an owner, right? So you buy a stock in a company that makes, for example, pepper mills, all right? So we're going to give this company money, hoping that this company does so well, they sell a gazillion pepper mills, which means the value of their company is going to increase and your investment's going to increase. So you're becoming an owner of a company when you purchase a stock, all right? So you're an owner. Versus bonds, what you're actually doing is loaning money to, say, the government, all right? In return, they're going to promise you typically a small rate of return. Okay, so you're either an owner when you buy stocks, or you're a loaner, you're loaning money with a promise to have money paid back to you with some interest, okay? Typically, stocks are more risky. There's more risk involved, all right? But they usually, over time, they have increased more or have a higher rate of return. Bonds, less risk, typically safe, but they won't get you a high rate of return.
No risk it, no biscuit.
No risk it, no biscuit. All right. So let me tell you a quick story. Then this is not my story. Matter of fact, Elena from the Washington Financial Group wrote this article, and I thought it was a great analogy. You guys ever been to like King's Dominion, right?
Yeah.
Or you ever see that ride, the boat ride where you get in and it swings up and it swings
favorite.
down? Oh, I can't stand that ride. Goes up, goes down, goes up, down. All right. So if we're talking about stocks and bonds, and you take a look at that boat, right? And you think about the swings and the volatility in the market. If you're sitting on the end of the boat, right, it's going to swing up high, right, and it's going to come back low. So a big high, big low. If you're in the middle, right, it's going to still go up, but it's not going to go up as much, and it's less of a risk. So if I was to get on that ride, if someone pointed a gun in my head and said, hey, you got to get on that boat ride, I'm sitting in the middle, all right, because I don't like that boat ride, first of all. But if you're a young investor or someone who wants to take a chance or a risk, you're going to sit at the end of that boat, so you get a higher swings. Typically, over time, again, if you take a little bit of more risk, you're going to have a higher rate of return over time. Okay. Any other questions about stocks and bonds?
When should you start
looking
at them?
So when we talked about the 401k plan, you gotta pick an investment. You decide if you want to participate. You decide what percentage of money you want to put into the plan. Then you have to decide. Sometimes you have to decide where to invest it. Right? Do you invest it in stocks? Do you invest it in bonds? If you're younger, and you should probably have a mix. But if you're younger, should you have more stocks or more bonds?
I don't know.
Bonds.
Stocks.
Right? Because stocks over time are probably, while there's more risk involved in it, they're probably going to give you a higher rate of return over time, and you can tolerate that high swing of the boat and the low swing, the high swing, the low swing. All right. Hopefully, we have more high swings than we do low swings, which we have historically speaking. So when you make your investment selections in your 401k plan, you probably want to have a little bit of both, but probably more stocks and bonds. If you don't like picking and choosing your funds and you don't like all this stuff, they're typically in a 401k plan, you have something called a target date fund, where you can just put all your money in this target date fund. And the target date fund has a year after it, like 2050 or 2030 or 2040. And that year is the year you are supposed to retire. It's close to age 65, and it's based on your date of birth. So if you're really young, you probably want to, like, what's your name again? I'm sorry.
Cassandra?
Cassandra, that's not your name. But Cassandra, as a young person, you probably want to pick a target date fund like a target date 2060. It's way off in the distance. It's heavily weighted in stocks and has some bond holdings in there as well. But it changes over time and it becomes more and more conservative as you get closer to the year 2060. Okay, but you don't have to do anything. It does everything for you. So look for those target date funds. Unless you really like picking and choosing your funds, it's a great idea to kind of consider using a target date fund if you're one of those younger investors. Any other questions about stocks and bonds?
I don't understand bonds really. Why would anyone invest in bonds?
Because they're safe. You're like in the middle of that boat. All right. So usually you're going to be promised money that's going to be paid back to you in terms of interest. So there's little chance of you losing your money, but little chance of you gaining 8%. You're not going to get 8% in bonds. All right. So it's safe, but low rate of return.
Okay.
All right. Excellent question.
I have a question kind of dealing with present day terms. Like, the market is clearly not doing too well. Why wouldn't people be buying lots of stocks now in hopes that once this coronavirus threat is over, the stock market will
That's a great
go
question.
back up?
For people who are financially savvy, now is a great time to buy stocks because the price is relatively low, right? You're buying low, hoping it will go back up, and so you can sell it at a higher price.
Buy low, sell high.
There you go. Buy low, sell high. But the reason why people don't, a couple reasons. One, you may not have cash to just go in and buy stocks and stuff. But two, people are scared. Their emotions, sometimes our emotions get in the way of making rational decisions. So oh, the stock market's it's going down. It's terrible. I'm not going to put money in there and lose all my money. So, but it is a great time to buy when the stock market is down. Very good question.
Where do you go to buy stocks? How do you buy them?
Well, you can actually buy them you can go online now and open up a E-Trade account or something like that. Or you can go to a financial advisor and they can help you.
So is this part of your job? Do you help people with this?
Yeah, yes. We typically work with portfolios involving mutual funds, but yes, we can buy stocks and bonds.
Very cool.
All right. Thank you for joining us today. Hope that was helpful. Have a wonderful day. Tom Leverone in the Washington Financial Group and my compadres signing off. Thank you and have a great day.
That's going to do it for this week's show. Thanks for listening. If you have a question that you'd like us to address in a future episode, shoot us an email at info@washfinancial.com. If you enjoy our show, we'd love for you to subscribe on iTunes or wherever you access your podcasts. The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA, and SIPC. Investment advice offered through Global Retirement Partners LLC, a registered investment advisor. Global Retirement Partners, Washington Financial Group, a division of Hub International Mid-Atlantic, and Hub International are not affiliated with LPL Financial.